You are welcome to our Forex Trading course. If you take this course from the beginning to the end, you will learn everything you need to know to participate in the Forex market and even become a pro in trading. You do not have to pay for any other course, as everything you need to succeed is in this course. Now, what will you learn in this course? You will learn the basics of Forex, indicators, price action trading, and you will get a few vital trading wisdoms that will help you all through your trading career. We have broken down our course into 4 stages, and this video covers the very first stage, which is the basics of Forex trading, in which you will learn the following: Basics of Forex trading, concept of margins, Forex terminologies, currency pairs, concept of bid and ask price, and spreads. So now, let us begin. What is Forex? Forex is the short form of the term foreign exchange. It is also known as FX. A simple way to define this is by referring to it as a global market that allows one to trade 2 currencies against each other. If you're a traveler and you are at the airport, you will usually have to find a currency exchange booth and then exchange the money you have in your wallet into the currency of the country you are visiting. You go up to the counter and notice a screen displaying different exchange rates for different currencies. An exchange rate is the relative price of 2 currencies from 2 different countries. You find Indian rupee and think to yourself, "Wow, my $1 is worth 75 Indian rupee, and I have $10. I'm going to be rich." When you do this, you've essentially participated in the Forex market. In summary, Forex is considered to be the largest market in the world with a total liquidity of more than $5 trillion every day. Yes, every living day. Now, when can you trade Forex? For starters, the Forex market can be traded anytime and any day. But the Forex that you need to understand here is the Forex that involves you using digital means to scoop out some profits using analytics. So when can you trade Forex? Forex is traded internationally from Mondays till Fridays. Forex has 4 major trading sessions in 24 hours, and it will be important for you to know the period in which they are active. The 4 sessions include the Sydney session, the Tokyo session, or Asian session, the London session, or European session, the New York session, or North American session. During these sessions, the market becomes really active, and that's when the major market movements occur. And these sessions start from as early as 7 a.m. in their country time and end as late as 6 p.m. in their country time. You should note that you can trade the market when it is not in session, but you need to understand that the markets will most likely move really slow during those times. That is why trading during these sessions are important. So when does the market generally open and close? The market generally opens for trading on Sunday by 10 p.m. following the London time and closes by Friday 12 a.m. following the London time. So what is the best time to trade Forex then? From my own personal experience, the best times to be in the market is from 11 a.m. London time till 8 p.m. London time from Mondays to Thursdays. And yes, I didn't include Fridays. Why? This is because every Friday volatility seems to reduce, and it is not good for making good profits, especially for scalpers. Only experienced traders know how to deal with Friday markets. I will explain why all of these are so later in this course. Who can trade the Forex market? Anybody and everybody that wants to convert their currency to another currency has basically traded Forex, but the main Forex traders are classified into retail traders and institutional traders. Retail traders are traders like you and I, looking to take advantage of the Forex market with our knowledge and skills. While the institutional traders are big institutions like banks, Forex brokers, and many other big institutions that control a huge chunk of cash. The institutional traders are what I call the market movers. They are the ones in charge of volatility. When the institutions do not trade, then the market barely moves. And like I mentioned earlier, the best trading times are from 11 a.m. London time to 8 p.m. London time. These periods are the periods that many of these institutions are trading the Forex market, so it is best to trade when they are trading. What is a margin? When trading, you are only allowed to put up a small amount of capital to open and maintain a new position. This capital is what we call your margin. For example, if you want to buy $100,000 worth of USD JPY, you don't need to put up the full amount, you only need to put up a portion, like $3,000. The actual amount depends on your Forex broker. In simpler words, we can say that margin is a portion of funds that your broker takes from your account balance to keep your trade open. This position is usually locked down by your broker till the position is closed. So in the case where you want to buy $100,000 worth of USD JPY with your capital of $3,000, if you lose the trade, it doesn't mean you lost $100,000, but instead, it means you have used up your margin. Therefore, most of the time, when it comes to trading Forex, your ability to open trades is not necessarily based on the funds in your account balance. More accurately, it's based on the amount of margin you have. This why, when you open 5 trades with a $100 account using an outrageous lot size, your broker will not allow you to open more positions. Now let us look at important Forex terminologies. Now that you know what Forex is all about, we can dive into the Forex terminologies. It is important to learn these Forex terminologies just in case you need to do some more research on your own or you need to discuss with others. You will be able to understand and communicate the Forex terms properly. So, without further ado, here are the common Forex terms you should know. 1. Go long means to buy. 2. Go short means to sell. 3. Bullish market means market that's moving upwards. 4. Bearish market means market that's moving downwards. 5. Hawkish is a term used in news trading, which means that the interest rate has been increased and it means good news for investors of a particular currency, meaning that the currency will rise. 6. Dovish is also another term used in news trading, which means that the interest rate will not increase, and it means bad news for investors of a particular currency, meaning that the currency will not rise. 7. Ranging means the market is moving upwards and downwards continuously in a sideways manner. 8. Trending means market is moving in the upward direction only, or the market is moving in the downward direction only. 9. NFP is a very common term in Forex. It is the short form of non-farm payroll. This is the most important news in Forex trading as it causes one of the biggest shifts in the market. NFP news is released on the last Friday of every month. We will discuss more on the NFP news as we move on in this course. These terminologies I listed above are the very basic ones you need to know before we dive deeper into this course. I cannot give all the terminologies all at once, so you will not feel overwhelmed and begin to confuse yourself and forget them. So as we go on, I will be telling you to note some extra terminologies down. So create a portion in your book or jotter that will contain other terminologies you will note later as we go on in this course. Now let us look at currency pairs. Currency pairs are two currencies that you are going to be trading against each other. Example of currency pairs are GBP USD, USD CAD, and so on. If you look at these currencies pairs, you will notice that they are usually listed in pairs and not single. The first currency is called the base currency, while the second one after it is called the quote currency. Note these down. That is for your USD currency pair. UR is the base currency, and USD is the quote currency. Note that 1. The base currency are always stronger than the quote currency 2. When a currency pair is rising, it means that the base currency is either gaining strength or the quote currency is getting weak. And also, when a currency pair is falling, it means the base currency is either getting weak or the quote currency is gaining strength. 3. If the quote currency and base currency are both acting strong at the same time, the currency pair will be ranging like crazy. 4. If the quote and base currency are both acting weak at the same time, the currency pair will do what we call sleeping. Sleeping or a sleeping market is a market that is neither ranging nor trending. Note this down. Let us take EURUSD for example. EUR is stronger than USD because EUR appears to be the base currency. When EURUSD rises, it can mean two things. 1. The USD currency is getting weak. 2. The euro is getting strong. Hence, if the euro is getting stronger, that means all other EUR currency pairs in which EUR is the base currency will also be rising at the same time. For example, if EUR-USD is rising due to the strength of EUR, it means that EUR-USD will rise, and it also means that EUR-GBP, EUR-CHF, EUR-CAD, and other EUR pairs will rise too. Note also that if it is the USD that is getting weaker, it means that EUR-USD will rise, but does not necessarily mean other EUR pairs will also rise. For example, if EUR-USD is rising because of the weakness of USD, it means that EUR-USD will rise, but it doesn't mean that EUR-AUD will also rise. Reverse is the case when EUR-USD is falling. When EUR-USD is falling due to the weakness of EUR currency, other EUR currencies will also fall. But if EUR-USD is falling due to the strength of the USD currency, it means other EUR currency pairs might not fall. This also means that currency pairs that have USD as their base. Currency will rise because of the strength of the USD currency. Do not worry if everything sounds confusing now. You will get to understand them better when you begin to trade, especially when you begin to observe the effect of news of pairs, now that we understand what the currency pairs are all about. Let us look at the concept of bid and ask price. The simple definition of bid price is bid price is the price that buyers are willing to buy, while ask price is the price that sellers are willing to sell. In the image showing below, showing GBP AUD 1.76994 to 1.77016. The 1.76994 is the bid price, and the 1.77016 is the ask price. If you subtract the ask price from the bid price, you will get the spread value. We will dive into spreads later in this course. Let us say you receive $10,000 from a friend and you walk to a Japanese bank to convert that JPY, Japanese yen, and let us say the rate of exchange is 100 JPY to 1 USD. The bank will give you 1,000 JPY cash as the equivalent of $10,000. Let's say you go back to the bank the next day to convert your JPY money back to $10,000, but on getting there, the bank rate is now 120 JPY for 1. It means you'd have to pay 1.2 million JPY to get the same 10%. In this situation, 100 JPY is the bid price, and 120 JPY is the ask price. This is one of the ways banks make their money. You just paid them 200,000 JPY for just exchanging currencies. And this is how Forex traders are making money from volatilities. This is why I refer to Forex money as free money. As you can see, the bank didn't have to do any extra work to make 200,000 JPY. This is why banks are living like kings. As I was saying, the bid price is the price that buyers are willing to buy, and the ask price is the price that sellers are willing to sell. Buyers and sellers in this case are not humans. This is because when you buy from the market and you sell to the market. And market in this case is not your usual market where you go and shop groceries from. The market I'm referring to is the foreign exchange market. Next, let us look at what a spread is about. Like I said, the spread is the difference between ask and bid price, in the example I gave above. The spread is 120 JPY minus 100 JPY, which equals to 20 JPY, meaning that the spread is 20 JPY. This spread is what banks make money off of. This same spread is what brokers profit from. Brokers can tell you that they have very low spread, but it is not possible for brokers to have zero spread. If not, they will be losing a lot of Forex money. When brokers charge you, they will charge you using spread, and they will charge you in pips. We will still deal with brokers later in this course. This is why, when you place a trade, your trade will be in loss automatically until it moves in a number of pips equivalent to the spread value. But we will get to all of this later, and you will understand it better. Another thing to note is that spreads usually vary depending on time. When all markets are open at the same time and the volatility is high, the spread is usually low. And when the markets are less volatile, the spread will be really high. This is why times around 11 a.m. to 8 p.m. London time are the best times to trade Forex, because there is high volatility and low spread. If you go to your MT4 or Trading View app after 8 p.m. London time and you check your 1-minute time frame, you will discover that the movements of price are not really effective. They are not really moving. But check back tomorrow around 11 a.m. to 8 p.m. London time. You will discover how fast the markets will be moving in a 1-minute time frame. Another thing is to check the spreads during these times. You will discover that the higher the volatility is, the lower the spread will be, and the lower the volatility is, the higher the spread will be. So don't just go about trading during any period. This is why you need to trade during sessions. That will be all for this chapter. In our next chapter, we will be looking into pips.